Let's stick with South Africa, where today the SARB retained the country's repo rate at a 15-year high of 8.25%. The Monetary Policy Committee of the Reserve Bank believed that the country's inflation is currently anchored at a level that is not so divergent from that of the SARB. The Wednesday's whole decision means that South African banks' prime lending will remain at 11.75%. Now let's get more on the state of the economy from the SARB Governor, Leseja Kganyago.
The economy performed worse than expected in the fourth quarter of last year, expanding just 0.1%. Growth for 2023 as a whole was 0.6%. The main reason for this bad performance was supply-side problems. Electricity load shedding was worse than in previous years. Port and rail problems also emerged as binding constraints on output. Our forecasts indicate a modest growth acceleration from this year as these supply-side constraints relax. In particular, we expect the load shedding burden will ease somewhat. While we estimate electricity shortages took 1.5 percentage points off GDP last year, we expect this to moderate to 0.6 percentage points this year and 0.2 percentage points in 2025. Overall, we see growth at 1.2% this year, improving to 1.6% by 2026. These projections are better than the 2023 outcomes, but below longer-run averages, which are around 2%. The risks to this growth forecast appear balanced. Turning to inflation, South Africa had a more gradual acceleration in inflation than many peer countries, with a lower peak after COVID. However, the return to target has been slow. The most recent inflation numbers showed yet another delay on the way back to our 4.5% objective, with headline up to 5.6% in February. This is nearer the top of our target range than the midpoint. Core inflation also rose to 5%. This rise in core was due to an acceleration in services, which was led by the medical aid component. Services inflation is now at its highest since 2019. This suggests that South Africa is joining the global trend of services rather than goods becoming a major source of inflation. The committee still sees headline inflation heading back to 4.5%. However, given extra inflationary pressures, headline now reaches the target midpoint only at the end of 2025, which is later than previously expected. As a result, the policy stance in our baseline forecast also starts to normalize later. In assessing this forecast, the MPC noted a range of risks. Inflation expectations have moderated in the latest survey. This is welcome, but 2-year ahead expectations are still in the top half of our target range. Expectations are projected to ease towards our 4.5% objective as inflation slows, but we have little margin to absorb shocks as long as inflation expectations are high. Regarding food prices, we are at a difficult juncture. Last year, food inflation hit the highest levels since 2008. Food inflation has now slowed, but this is a critical time in the growing season, and the weather has been unusually hot and dry, which may cause food inflation to pick up again. Considering the exchange rate, the rand has been trading somewhat weaker than we expected at our last MPC meeting. This is partly due to interest rates in the major advanced economies staying high for longer. The currency is also under pressure from weakening terms of trade. Furthermore, investors see significant near-term domestic uncertainty. We view the exchange rate as undervalued. On balance, the various risks to the inflation forecast are skewed to the upside. Against this backdrop, the MPC decided to hold the repo rate unchanged at 8.25%. The decision was unanimous. At this level of raise, the policy stance is considered restrictive, consistent with the inflation outlook and the need to address elevated inflation expectations. The inflation and repo rate projections from the quarterly projection model remain a broad policy guide, changing from meeting to meeting in response to new data. The committee decisions will continue to be data dependent and sensitive to the balance of risks to the forecast. Stabilizing inflation at the midpoint of the target band will improve the economic outlook and reduce borrowing costs. Finally, we reiterate the views of the MPC on additional measures that would improve economic conditions. These include achieving a prudent public debt level, improving the functioning of network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains.